Hey, yeah. And then I get some money. And then I get some money. And then I get some money. Alright, what's up guys, it's Migs from Market Open. That song gets me hype every time. Alright, what I wanted to cover today is something I talked about in one of the other videos, is what you should be looking for at the beginning of the day from the S&P 500. So usually at the beginning of the day, I look at all the stocks, which way they're gapping up, they're moving up, down, and then what I do is actually I look at the market. What is it doing? Is it gapping up? Is it gapping down? As you can see, it's always either gapping up or down, either way. And that will determine which way I'm going to go. So I wanted to explain something to you guys that happens in the market mostly every day. So in the market, obviously the S&P 500, which is the top 500 stocks, has a lot of the stocks that I trade in it. So if the market's gapping up, I'm actually going to be looking for shorts mostly. And if the market is gapping down, I'm going to be looking for longs. The reason why that happens is because 80% of the time, the gap fills within the same day. And then 90 to 95%, the gap will fill within the next 10 days. Okay, so let me do a little bit of explaining here. So this is a 5-minute chart from the past 5 days. So let's just take it from here. So right here, what I do is I mark out the previous days close. So right here at the top of this candle, right here, the market closed, and the market actually gapped down. During this day, there wasn't a lot of volume, so kind of the market just went straight sideways. So the gap actually ended up not closing. So knowing that, I knew that the gap had to close. It most likely has to close. So the next day, the market actually gapped up, and it kept going up. So as you notice here, it actually closed the gap. So right about here, it went up a little bit higher and then fell off. So I knew immediately that if it's going to start going up, it's going to go fill the gap. It might, after that, I'm not really quite sure which way it's going to go, but I pay attention to that to kind of depend on which way I'm going to go, either long or short. So now let's go to the next day. So the next day, the market closed here, and then the market was gapping up. So I immediately know that if it's gapping up and the previous closing day was obviously way lower, I'm going to be looking for shorts because the gap needs to fill. So as you can see, it actually ended up going lower and lower and lower, and it didn't actually fill that day. So I was thinking right around here, I think I ended up losing some money on it because I thought it was going to keep going lower just to fill the gap. It didn't, but we are in December, like late December, and I figured that it's going to have to fill one time or another. So after this, after having such a big gap that I know needed to be filled, whichever way the market was going to go, I figured we were going to have a down day. It was inevitable that I think this was one of the last days of trading, and I believe this was the last day of trading for 2017. So as soon as the market opens, it opened up red. It flushed down, and as soon as it started chomping around here, I knew that it was probably going to consolidate and keep going a little bit lower. As you can see, it literally filled the gap almost to the T, and it started going back up. And then by the end of the day, which, mind you, was the very last day of trading for 2017, a bunch of people just sold off all their shares for tax purposes and all that stuff. But that's a whole other topic. So now I kind of want to explain why the market closes the gap every single day. So let's just say that you are a trader at an institution fund, and like a hedge fund or something, and your boss comes up to your desk and says, hey, I need you to buy 5 million shares of Planet Fitness or Nvidia or whatever. It doesn't really matter, just using that as an example. So now there are two lines that are very important that determine your bonus whenever you work at a big fund like that. So one line is the VWAP, so it's the volume weighted average price. You guys always hear me talking about that, which is the white line that's here. So if you are buying 5 million shares of a certain company, for you to be able to get your bonus, you have to buy it below the white line, because obviously you want to buy it low and sell it high. But now let's flip that around. Let's just say that your hedge fund already has 5 million shares of Planet Fitness. Now you guys want to get rid of 3 million shares. So now what you have to do is you have to sell above the volume weighted average price, which will determine that you'll be making more money for your hedge fund and ultimately making a bigger bonus and making more money. All right, now the other line that I want to talk about is the previous day's close. So now let's just say that your boss is telling you that you have to sell 3 million shares of Planet Fitness, and the stock ends up gapping up, or the market starts gapping up. So usually if the market gaps up, a stock will gap up as well, slightly. So now what you do is, if you're working at a hedge fund and your boss tells you to sell off some of those shares, now if it gaps up to the next day, you have between the previous day's close and where it gapped up to be able to sell all those shares that you need to get rid of, because automatically you're making a profit from the previous day's close. So if I was working at a hedge fund here, so this line right around there, so the previous day's close is right here around 267.86. And so basically you would be getting a bonus selling all the shares above yesterday's closing price between this, what's it called, in this little time frame right here. So you're automatically making money. Now, remember that most of the volume in the market, 80% of it, is the institutional money. So it's algorithms, it's prop funds, it's hedge funds, and they're the ones that are making the rules. They're the ones that have most of the money in the market. So us as retail traders, we have to learn the rules and know which way the big money basically wants to go for us to be able to make a smart decision on which way we should be trading, which way we should be going long or short. So yeah, hopefully that helps you guys out and makes you help. All right, 1, 2, 3. Hopefully that helps you guys out to be able to make a better choice in the morning. If you guys do have any questions, make sure to leave them down in the comment section below. Make sure to give this video a like, and I will talk to you guys next time.